Hello and Assalamualaikum everyone, and to Dr. Isa. My name is Bibi Najiha, HIKMAH binti HAMZAH, number matrix BB22110391. In this video, I will be explaining the difference between Islamic bank financing and convention bank loans. Have you ever wondered how Islamic financing is different from regular bank loans? First difference is in terms of modes and finance. For Islamic bank financing, it has three modes. First, rental arrangement, known as ijara. Ijara is where the usufruct of a durable asset is leased out to a customer against a certain rental payment. Second, trade or sale basis, which includes murabaha, musawama, salam, istisna, and tijara. Murabaha is a sale where bank disclose the cost and profit to the customer. Musawama is an opposite of murabaha. Salam is a sale where 100% payment is made in advance and goods delivery is set on a future date. Istisna is a sale transaction with spot or part payment for manufactured goods. Tijara is a sale and agency-based financing facility where finished stock is sold by customer to bank to generate working capital for further business operations. Meanwhile, for convention bank loans, it has only one mode, which is loan mode. It does not matter whether it is individual customer, business partnership, or corporate client, all of them can avail an array of products with an underlying mode of debt only from a conventional bank. Conventional bank loan have different customer segment, but all of them simplify to a loan advanced by a bank to its customer. One example, if a customer avail a house from a bank and something happen, the bank will then ask the customer to keep paying monthly installment despite the asset loss till insurance settlement comes in. On the other hand, in terms of interest rate for both banks, Islamic bank financing prohibit lending money to the customer with interest but promote risk sharing. For example, the bank will buy the property the customer wants and sell to them at a higher per agreed price include profit margin. This way, the customer will repay them with a fixed amount without any interest involved, aligned with Islamic law. For conventional bank loans, it operates on traditional financial transactions including interest rates. For instance, if a customer takes out a mortgage to purchase a home, the bank will lend them some money to buy the property, but in return, the customer have to pay them back within the time period they set with additional interest charge. The interest rate can be fixed or varies. That serve as the bank profit mechanism. Lastly, the difference in terms of risk sharing. For Islamic bank financing, it is a risk sharing bank. Why? Because in Islamic bank financing it has the modes that I said earlier in the first difference, the definition, that Islamic bank financing have musyarakah and mudarabah, and they both are partnership, and they are sharing profit as per agreed ratio and sharing loss as per investment ratio, and that's why they are called the risk sharing bank. Meanwhile, for conventional bank loans, they do not share any risk with their customers at all. All the financial risk is borne by the borrower, which is the customer. Conventional banks only offer debt to customer. So that's why the convention bank loans is not a risk is not a risk-sharing bank. So now we have gained a bit of a knowledge of the difference between Islamic bank financing and conventional bank loans. So, to sum up, Islamic bank financing and conventional bank loans differ fundamentally in their approach. Islamic financing operates through various modes such as leasing, ijarah, sales-based murabaha and salam, partnership, mudarabah and musyarakah, all of which avoid interest and instead promote profit sharing and ethical investment. In contrast, conventional banks use a single loan mode, lending funds with interest as the primary source of profit. Thank you for watching my video. I hope more or less this will help you to differentiate between Islamic bank finance and conventional bank loans. Bye bye.